At a news conference in June 2013, Federal Reserve Chairman Dr. Ben Bernanke indicated that the Fed might not act as aggressively to expand employment and GDP. In response, the Dow Jones Industrial Average fell by about 200 points, and interest rates increased. Most economists agree that the Fed chair is more important to the U.S. economy than the President of the United States because the Fed chair does not need the approval of Congress to enact most policies. When the Fed acts to change interest rates, it directly affects businesses, such as home builders and car dealers. Other businesses are indirectly affected because these changes in interest rates cause changes in aggregate demand.
Why is it we haven't had the courage and don't, and under what circumstances will we? And I want to start with Bill Martin because his experience is a very interesting experience. His 19 years was divided into different periods. In the first period, that average that Burl Sprinkle spoke about averaged two very different periods. An early period of very slow growth and slow inflation, a later period of what at the time was regarded as creeping inflation. Now we'd be delighted to get back to it. People don't remember that at the time that Mr. Nixon introduced price and wage controls in 1971 to control an outrageous inflation, the rate of inflation was 4.5% per year. Today, we'd regard that as a major achievement. But the latter part of the period when you were chairman was a period when the inflation rate was starting to creep up and money growth rate was also creeping up. Now, if I go from your period, you were eloquent in your statements to the public, to the press, to everyone about the evils of inflation and about the determination of the Federal Reserve not to be the architect of inflation. Your successor, Arthur Burns, was just as eloquent, made exactly the same kinds of statements, as effectively, and again, over and over again, said the Federal Reserve will not be the architect of inflation. His successor, Mr. G. William Miller, made the same speeches and the same statements and the same protestations. His successor, Paul Volcker, he is making the same statements. Now, my question to you is, why is it that there has been such a striking difference between the excellent pronouncements of all chairmen of the Fed? Therefore, it's not personal on you. You have a lot of company, unfortunately, for the country. Why is it that there's been such a wide diversion between the excellent pronouncements on the one hand and what I regard as a very poor performance on the other?
Because monetary policy is not the only element. Fiscal policy is equally important.
You're shifting the buck to the Treasury.
Yes.
To the Congress. We'll get to Mr. Brown.
Yeah,
don't worry.
Right. The relationship of fiscal policy to monetary policy is one of the important things.
Could you remind us, the general audience, when you say fiscal policy, what you mean in distinction to monetary policy?
Well, taxation, the raising revenue.
And spending.
And spending.
And deficits.
And deficits, yes, exactly. And I think that you have to realize that when I've talked for a long time about the independence of the Federal Reserve, that's independence within the government, not independence of the government. And I've worked consistently with the Treasury to try to see that the government is financed. Now, this gets back to spending. The government says they're going to spend a certain amount, and then it turns out they don't spend that amount. It doubles.
The job of the Federal Reserve is not to run government spending. It's not to run government taxation. The job of the Federal Reserve is to control the money supply. And I believe, frankly, I have always believed, as you know, that these are excuses and not reasons for
well,
the
that's where you and I differ, because I think we would be irresponsible if we didn't take into account the needs and what the government is saying and doing. I think if we just went on our own irresponsibly, I say it on this because I was in the Treasury before I came to the Fed, and I know the other side of the picture. I think we'd be rightly condemned by the American people and by the electorate.
Every central bank in this world, including the German central bank, including the Federal Reserve System, has the technical capacity to make the money supply do over a period of 2 or 3 or 4 months, not daily, but over a period has the technical capacity to control it.
Dr. Is that right?
You cannot explain the kind of excessive money creation that has occurred in terms of the technical incapacity of the Federal Reserve System or of the German Central Bank or the Bank of England or any other central bank in the world.
Our central bank, the Federal Reserve, helps maintain high U.S. employment and stable prices for consumers. The main tool the Fed uses to influence the economy is interest rates, the price everyone pays to borrow money. High interest rates make borrowing more expensive, so you end up paying more for things like home and car loans. Then again, there are upsides. The money you have stashed in savings and money market accounts will earn higher interest. As a result of the Great Depression, Congress mandated the Federal Reserve Act to give the Federal Reserve's Board of Governors broader responsibility to act so as to promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. Since World War II, the Federal Reserve has carried out an active monetary policy. Monetary policy refers to the actions the Federal Reserve takes to manage the money supply and interest rates to achieve macroeconomic policy goals. The textbook lists the Federal Reserve's 4 monetary policy goals: 1. Price stability, 2. Employment, 3. Stability of the financial markets and institutions, and 4. Economic growth. The control the Fed has over the supply of money and interest rates is the source of its ability to achieve goals 1 and 3. But how much control does the Fed have over real variables such as employment and economic growth? The textbook argues that increases in per capita real GDP are the result of growth of labor productivity. In turn, increases in labor productivity are caused by increases in the quantity of capital per hour worked and the level of technology, not changes in the money supply. For most of the 1950s and 1960s, the inflation rate of the United States was about 4% or less. During the 1970s, the inflation rate increased, peaking during the 1979 to 1981 time, when it averaged more than 10%. After 1992, the inflation rate was usually less than 4%, until increases in oil prices pushed it above 5% during summer 2008. The effects of the recession caused severe months of deflation, a falling price level, during early 2009. The inflation rate is often measured as the percentage change in the consumer price index from the same month the previous year. The CPI is often used as an indicator of inflation by U.S. consumers because of its relevance to the U.S. consumer as an indicator of the cost of living. It includes the costs of food, fuel, electricity, clothes, and drink, and is available monthly, with a lag time of only 20 days after the month ends. It makes good fodder for planning and reacting to economic events around us. The PPI is very similar to the CPI, except it is most related to commercial producers. Business costs and revenues are tracked by this index. Monetary changes through time give businesses a measure of how the economy is reacting to macroeconomic events. The PPI is also much more reactive to the economy, reacting through the U.S. economy and those of all major U.S. trading partners. The Trimmed Mean Personal Consumption Expenditures, or PCE, inflation rate produced by the Federal Reserve Bank of Dallas, is an alternative measure of core inflation in the Price Index for Personal Consumption Expenditures, PCE. The data series is calculated by the Dallas Fed using data from the Bureau of Economic Analysis, the BEA. Calculating the trimmed mean PCE inflation rate for a given month involves looking at the price changes for each of the individual components of personal consumption expenditures. The individual price changes are sorted in ascending order, from fell the most to rose the most, and a certain fraction of the most extreme observations at both ends of the spectrum are thrown out or trimmed. The inflation rate is then calculated as a weighted average of the remaining components. The trimmed mean inflation rate is a proxy for true core PCE inflation rate. The resulting inflation measure has been shown to outperform the most conventional food and energy measure as a gauge of core inflation. The Employment Act of 1946, established the dual mandate of the Federal Reserve to support maximum employment and price stability. The open market operations allow the Federal Reserve to increase or decrease the amount of money in the banking system as necessary to balance the Federal Reserve's dual mandates. The open market operations are done through the sale and purchase of United States Treasury securities, sometimes called Treasury bills, or more informally, T-bills, or just Treasuries. The Federal Reserve buys Treasury bills from its primary dealers. The purchase of these securities affects the federal funds rate because primary dealers have accounts at depository institutions. Beyond influencing the level of prices and the level of output in the near term, the Federal Reserve can contribute to financial stability and better economic performance by acting to contain financial disruptions and to prevent further problems outside of the financial sector. Modern financial systems are highly complex, interdependent, and may be vulnerable to systemic disruptions, such as those that can occur as a result of a sudden plunge in stock prices. The Federal Reserve can enhance the financial system's resilience to such shocks through its regulatory policies. If a disturbance develops, the Federal Reserve can also cushion the negative effects on financial markets and the economy by providing funds to commercial banks through open market operations or discount window lending.
Some investors are now wondering if the economy will be strong enough for the Federal Reserve to raise interest rates 2 more times this year, which is what is widely expected. Joining me right now is former Federal Reserve Chairman and author of The Courage to Act, Dr. Ben Bernanke. Good to see you, sir. Thank you so much for joining us, Dr. Bernanke.
Hi, Maria. Glad to be here.
Well, you know, there is this expectation that the Federal Reserve will continue raising interest rates. But what's your sense of the economy right now, sir? Because a lot of people are wondering and questioning if, in fact, it's even strong enough to see a string of interest rate hikes. And will the Fed sort of stomp out the growth that we're seeing just as it's gaining traction? What's your take on this?
Well, you know, this recovery has been pretty persistent. We're going into the 8th or 9th year of expansion. Pretty consistent growth, lots of jobs, and I think looking forward we still have a moderate growth outlook, and the Fed's going to continue its gradual rate tightening.
So how would you characterize the economy right now? I feel like the consumer has shown some signs of weakness. You know, the retail environment has been spotty, the auto industry sort of rolling over in the first quarter. What are you seeing?
Well, what the Fed is looking at is the fundamentals for consumption. Consumer wealth is up, house prices are up, jobs, 16 million jobs in the last few years, unemployment down, of course, consumer confidence is good. So all those things indicate that the consumer will be okay, and I think that's a big part of the story about why the Fed thinks the recovery is going to continue and why very cautiously and gradually they want to continue the tightening process.
Okay, so would you say that it was more the business side of the economy that was really pressured over the last several years, or the consumer? Because I feel like the business sector has been sitting on cash for quite some time.
No, that's right. So a disappointing aspect of the recovery has been capital investment, which has been, you know, not as strong as we would like. And we've seen a bit of improvement in the first quarter that capital investment was pretty decent. And to the extent that businesses are more optimistic about upcoming policy changes, maybe we'll see some improvement there as well. But that we do need some more strength from business investment to make this a really sustainable recovery. That's certainly true.
Yeah, which is why I want to get into really fiscal policy with you as well as monetary policy, Dr. Bernanke, because a lot of people are wondering if, in fact, that's going to be, you know, the catalyst that gets business moving again. But let me ask you about something that one of your predecessors used to speak about a lot, and that is the wealth effect. Dr. Greenspan, of course, would look at the stock market to get an indication of what would happen in terms of the broader economy, that so-called wealth effect. Do you think that the markets right now are showing some nervousness, and is that going to be a derailment?
Well, they are showing some nervousness, and I think, and I wrote in my book, that I think the markets kind of overdid the Trump trade a little bit after the election. I thought then, I think now, that the politics is going to be much tougher than it looks, and the fiscal policy changes, tax cuts and the like, are probably going to be slower, more delayed, smaller than was initially thought, and markets, are adjusting to that, and they've already begun to adjust to that. But again, I don't think that you need a big fiscal package to keep the economy moving forward. There's a lot of progress being made, and I don't think we need a big tax cut right now.
Yeah, I was reading some of your commentary about, what the president has been talking about, and you basically say, the idea that the economy was so weak during the campaign when Donald Trump was running as candidate was actually not what you were seeing at all, right? You write that in the New Forward in your book.
Well, there's a paradox. I mean, in terms of the recovery from the Great Recession, the U.S. economy is really doing quite well. Unemployment rate 4.4%. Stock market is up, as you mentioned. Job creation, confidence, all those things are very positive. But I have to give candidate Trump credit that he did identify some real dissatisfaction in the country, and it relates to some very long-term trends. A lot of inequality, slow wage growth, lots of things, particularly in the middle part of the country and among people with less education that have held them back and made them pretty dissatisfied.
You say that right now things are looking a lot better, and that we are certainly seeing a good situation with unemployment where it is. But one of the economists that I speak with a lot looks at tax receipts and income. And she said, look, when you look at the tax receipts, you can see that Americans aren't making enough money to actually put back into the economy in terms of consumer spending. Do you worry about that?
Well, I pay attention to that, too. I think that if you look at the job creation and the fact that wages are not going gangbusters, but they're growing more quickly now, between more jobs and higher wages, we are seeing more income. And it's reflected in when you ask consumers, in the consumer confidence surveys, how do they feel about their own financial situations, they're more upbeat about that than they've been in quite a few years. So I do think that the engine of the recovery will continue to be consumers and households, and income has been strong enough that's going to support their spending.
The Fed cannot affect unemployment and inflation rates directly. The Fed uses monetary policy targets to keep the unemployment rate and the inflation rate low. The two main monetary policy targets are the money system supply and the interest rate. The Fed typically uses the interest rate as a policy target. The Fed was forced to develop new policy tools because of the disruption that the U.S. financial markets suffered during the 2007-9 recession. The money demand curve slopes downward because a lower interest rate causes households and firms to switch from financial assets such as U.S. Treasury bills to money. All other things being equal, a fall in the interest rate from 4% to 3% will increase the quantity of money demanded from $900 billion to $950 billion. An increase in the interest rate will decrease the quantity of money demanded. When interest rates on Treasury bills and other financial assets are low, the opportunity cost of holding money is low, so the quantity of money demanded by households and firms will be high. The opportunity cost of holding money is the interest rate. Changes in real GDP, or the price level, cause the money demand curve to shift. An increase in the real GDP or an increase in the price level will cause the money demand curve to shift from MD1 to MD2. A decrease in the real GDP or a decrease in the price level will cause the money demand curve to shift from MD1 to MD3. The two most important variables that cause the money demand curve to shift are real GDP and the price level. An increase in real GDP means that the amount of buying and selling of goods and services has increased. An increase in the price level increases the quantity demanded, which increases the quantity of money demanded at each interest rate, shifting the money demand curve to the right. A decrease in the real GDP decreases the quantity of money demanded at each interest rate. A decrease in the price level decreases the quantity demanded of money, shifting the money demand curve to the left. 8 times per year, the FOMC meets in Washington, D.C. If the FOMC decides to increase the money supply, it orders the trading desk at the Federal Reserve Bank of New York to purchase U.S. Treasury securities. The sellers of these securities deposit the funds they receive from the Fed in banks, which increases their reserves. In normal times, banks loan out most of their reserves, which creates new checking account deposits and expands the money supply. If the FOMC decides to decrease the money supply, it orders the trading desk to sell Treasury securities, which decreases banks' reserves and contracts the money supply. For simplicity, we assume that the Fed can fix the money supply. Therefore, the money supply curve is a vertical line, and changes in the interest rate have no effect on the quantity of money supplied. Equilibrium in the money market occurs where the money demand curve crosses the money supply curve. When the Fed increases the money supply, the short-term interest rate must fall until it reaches the level at which households and firms are willing to hold the additional money. When the Fed increases the money supply, households and firms will initially hold more money than they want relative to other financial assets. Households and firms use the money they don't want to hold to buy treasury bills and make deposits in interest-paying bank accounts. This increase in demand allows banks and sellers of treasury bills and similar securities to offer lower interest rates. Eventually, interest rates will fall enough that households and firms will be willing to hold the additional money the Fed has created. In this figure, an increase in the money supply from $900 billion to $950 billion causes the money supply curve to shift to the right from MS1 to MS2 and causes the equilibrium interest rate to fall from 4% to 3%. When the Fed decreases the money supply, households and firms will initially hold less money than they want relative to other financial assets. Households and firms will sell treasury bills and other financial assets and withdraw money from interest-paying bank accounts. These actions will increase interest rates. Interest rates will rise to the point at which households and firms will be willing to hold the smaller amount of money that results from the Fed's actions. In the figure, a reduction in the money supply from $900 billion to $850 billion causes the money supply curve to shift to the left from MS1 to MS2 and causes the equilibrium interest rate to rise from 4% to 5%. We use these two models of the interest rate. The loanable funds model is concerned with the long-term real rate of interest, and the money market model is concerned with the short-term nominal rate of interest. The long-run real rate of interest is the interest rate that is relevant when savers consider purchasing a long-term financial investment, such as a corporate bond. When conducting monetary policy, however, the short-term nominal interest rate is the most relevant interest rate because it is the interest rate most affected by increases and decreases in the money supply. The Fed chooses the money supply or the interest rate as its monetary policy target. The Fed has generally focused more on the interest rate than the money supply. There are many interest rates in the economy, but for the purposes of monetary policy, the Fed has targeted the interest rate known as the federal funds rate. The federal funds rate is the interest rate at which depository institutions trade federal funds, the balances held at Federal Reserve banks, with each other overnight. When a depository institution has surplus balances in its reserves account, it lends to other banks in need of larger balances. In simpler terms, a bank with excess cash, which is often referred to as liquidity, will lend to another bank that needs to quickly raise its liquidity. The rate that the borrowing institution pays to the lending institution is determined between the two banks. The weighted average rate for all of these types of negotiations is called the effective federal funds rate. The effective federal funds rate is essentially determined by the market, but it is influenced by the Federal Reserve through open market operations to reach the federal funds rate target. The Fed does not set the federal funds rate. However, the Fed's ability to increase or decrease bank reserves quickly through open market operations keeps the actual federal funds rate close to the Fed's target rate. The orange line is the Fed's target for the federal funds rate, and the jagged green line represents the actual value for the federal funds rate on a weekly basis. The federal funds target for the period after December 2008 was 0 to 0.25%. Changes in interest rates affect aggregate demand, which is the total level of spending in the economy. Changes in interest rates will not affect government purchases, but will affect consumption, investment, and net exports in the following ways. First, consumption. Lower interest rates lead to increased spending on durables and reduce the return to saving, leading households to save less and spend more. Investment. Lower interest rates make it less expensive for firms to borrow, so they will undertake more investment projects. Lower interest rates can also increase investment through their effect on stock prices. Spending by households on new homes falls when interest rates rise, and increases when interest rates fall. Net exports. If interest rates in the United States decline relative to the interest rates of other countries, the value of the dollar will fall and net exports will rise. Expansionary monetary policy is the Federal Reserve's policy of decreasing interest rates to increase real GDP. Contradictory monetary policy is the Federal Reserve's policy of increasing interest rates to reduce inflation. The Fed can use monetary policy to affect the price level and, in the short run, the level of real GDP. In Panel A, short-run equilibrium is at point A, with real GDP of $16.8 trillion and a price level of 108. An expansionary monetary policy causes aggregate demand to shift to the right from AD1 to AD2, increasing real GDP from $16.8 trillion to $17 trillion, and the price level from 108 to 110, leading to point B. With real GDP back at its potential level, the Fed can meet its goal of high employment. In Panel B, short-run equilibrium is at point A, with real GDP at $17.2 trillion and the price level at 112. Because real GDP is greater than potential GDP, the economy experiences rising wages and prices. A contractionary monetary policy causes aggregate demand to shift to the left from AD1 to AD2, causing real GDP to decrease from $17.2 trillion to $17 trillion, and the price level to decrease from 112 to 110, going to point B. With real GDP back at its potential level, the Fed can meet its goal of price stability. Contractionary monetary policy is the Federal Reserve's policy of increasing interest rates to reduce inflation. The Fed can use monetary policy to affect the price level and, in the short run, the level of real GDP. Total reserve balances maintained is the amount of balances institutions hold in accounts at the Federal Reserve banks that are available to satisfy reserve requirements. Historically, this series excluded balances held in a reserve account for contractual clearing purposes. Most mainstream economists favor a low, steady rate of inflation. Low as opposed to zero or negative inflation may reduce the severity of economic recessions by enabling the labor market to adjust more quickly in a downturn, and reduce the risk that a liquidity trap prevents monetary policy from stabilizing the economy. The task of keeping the rate of inflation low and stable is usually given to monetary authorities. It's when the Fed uses a specified quantity of money to expand the range of securities it will buy, instead of focusing purely on short-term securities to influence the Fed funds rate. The range of securities includes treasuries with longer maturities, as well as other instruments that the Fed is not traditionally involved in, such as mortgage-backed securities. To enact normal policy and lower interest rates, the Fed will buy short-term treasuries, which mature quickly, turning into cash from the Treasury. To enact quantitative easing, the Fed is buying longer-term securities. Technically, they could sell these longer-term securities at any time. However, this would defeat the purpose of the quantitative easing. As a result, these securities expand the Fed's balance sheet dramatically and represent a long-term increase in the money supply. Keeping recessions shorter and milder than they would otherwise be is usually the best the Fed can do. The Fed needs to be able to recognize the need for a change in the monetary policy. If the Fed acts too late, it may destabilize the economy. Because it takes months for government agencies to gather economic statistics, there can be a lag time before the Fed recognizes that a recession has already started. The upward sloping straight line represents the long-run growth trend in real GDP. The curved red line represents the path real GDP takes because of the business cycle. If the Fed is too late in implementing a change in monetary policy, real GDP will follow the curved blue line. The Fed's expansionary monetary policy results in too great an increase in aggregate demand during the next expansion, which causes an increase in the inflation rate. Because it can take a long time for a change in monetary policy to affect real GDP, the Fed tries to set policy according to what it forecasts the state of the economy will be. For the Fed to succeed in reducing the severity of business cycles, it must often act before a recession, or an acceleration of inflation shows up in the economic data. The long-term data shows the effective funds rate does not always match the Fed's target. More importantly, the recent financial crisis highlights how powerless the Fed can be when faced with major changes in market interest rates. The Fed clearly followed rates downward after September 2007, when it began lowering its target rate from 5.25% to 1% in little more than 1 year. The Fed then ditched the idea of a single target in favor of a target range, from 0% to 0.25%, while nearly abandoning interest rate targeting altogether. In 2008, Fed Chairman Ben Bernanke noted, quote, "With respect to monetary policy, we are at this point moving away from the standard interest rate targeting approach, and, of necessity, moving toward new approaches," end quote. If the Fed did not have tight control over interest rates, it would have prevented them from falling in a manner that jeopardized its core approach to monetary policy. A contractionary monetary policy does not cause the price level to fall, but causes it to rise by less than it would have without that policy. An expansionary monetary policy is sometimes called a loose or easy policy. A contractionary policy is sometimes called a tight policy.
Welcome back. The Federal Reserve raising interest rates for the third time last month to a range of between 1 and 1.25%. Wall Street had been expecting at least one more rate increase this year. We are expecting that to happen in September. But earlier this week, Federal Reserve Chair Janet Yellen told Congress that the Fed is prepared to scale back on its rate increases should inflation continue to be soft. I'm back right now with Jim Grant. And Jim, we were talking about inflation, why this 2% number is so important to Janet Yellen. And earlier, when I asked you during the commercial break, we're not sure why. What do you think?
Well, she pressed for it years ago when she was a member of the Federal Reserve Board, when she was, I think, the president of the San Francisco Federal Reserve Bank. This number is now tacked up on the wall as if it were handed down from on high. 2%. We need 2%.
Right.
Why? We don't know. So 1960 to 1965, 6 years inclusive, there was not 1 year of those 6 in which the rate of inflation reached 2%. 1 year, I think 1961, it was 70 basis points, 0.7%. So that nowadays that would be the grounds for a kind of a panic, right? My God, deflation, 1930s, knocking the door. So what is it that's changed? Well, for one thing, of course, we are more encumbered. We have more debts, and they think we need some inflation to help us all pay our debts. But they never say that. And I think it's the intellectual dishonesty of this monetary policy approach that most rankles me. I can't stand it.
Well, I mean, it's been easy money for a long time.
It has.
And here we are looking at an economy that, yes, we are out of the throes of the recession, of the financial upset of almost 10 years ago now, but the economy is not doing all that great. I mean, look at GDP. 1.5% on average in the last quarter. You've got tax receipts down. Do you think that there is a risk things slow down as the Fed accelerates this?
Oh, yes. I think there's a big risk. And I think that Janet Yellen, in her testimony this past week and in the document that the Fed issued in late June having to do with their plans for the so-called normalization of the balance sheet, in every occasion, Janet Yellen has issued a PS. PS, if things don't work out, we will be back. We will be back with QE4. We'll be back.
That must make you happy.
Oh, it's delightful. It's,
so, in other words, they're going to be there regardless.
They will be there. So what they're saying, and again, people don't really take the measure of this. What they're saying is that there's no going back, that we are going to issue these dematerialized things we call dollars, these digital things that we type into a computer. The way they create credit is by typing in $ and something into a computer, and that is called a bank reserve, right? They issue dollars, they buy bonds from somebody, and that somebody deposits the proceeds, the dollars, into an account at the Fed. So the Fed, by buying bonds, owns the bonds, now $4.5 trillion, and somebody else, the bank, has an account at the Fed with dollars that didn't exist before. So that is what they call QE.
What about what's going on in the rest of the world? I mean, this past week, Bank of Canada raised interest rates. You've got Europe.
Well, there is the tom-tom beat of the central bankers that they intend to tighten. They intend to step back from these most radical policies of the past 10 years. That is the agenda of these central bankers. Now, whether they do it is another question. But that is what they're talking about. Even Mario Draghi, who has been leading the charge in QE, has been talking about this, much to the alarm of the people who own European securities at prices to deliver yields of less than nothing.
Right, and number of yields within Europe are actually negative. That's what we spoke about this past week when I had on the morning show the chairman of UBS, Axel Weber. Here's what he said about that.
What Europe is doing, it's falling in behind the Federal Reserve that is way ahead in normalizing monetary policy. Interest rates are now above 1%. They're still in negative territory in Europe. The ECB is still augmenting its balance sheet, and the Fed is contemplating reducing it. What the ECB will do is reduce their purchases, but it doesn't mean that the balance sheet will shrink anytime soon.
He basically said, yeah, rates are negative in Europe, but the European Central Bank, things are getting better, and they should be letting up on the stimulus.
They should, but there are consequences for their having suppressed rates. And the president or CEO of Deutsche Bank was on the tape maybe a week ago saying, he said, all this bond buying by the European Central Bank, all the aggressive buying without regard to price or value has served to destroy the method of price discovery by which we decide how to price credit. We don't know how to price credit, said he. Now, that is a soft-spoken but very eloquent and powerful denunciation of what the ECB has been about. When a banker can't price credit, what does that mean? Well, prices, credit interest rates are the most sensitive, I say the most sensitive prices in capitalism. They define risk, they discount future cash flows, and the central banks have determinedly and with malice aforethought, or with intended benevolence aforethought, have suppressed and manipulated and muscled around these prices for 10 years. And you can't tell me there's no consequence for that.
In Chapter 24, we developed a dynamic aggregate demand and aggregate supply model to take account of the following facts. First, the economy experiences continuing inflation. And second, the economy experiences long-term growth, with the long-run aggregate supply curve shifting to the right every year. Initially, equilibrium is at point A, with real GDP of $17 trillion and a price level of 110. Without monetary policy, aggregate demand will shift from AD1 to AD2 without policy, which is not enough to keep the economy at full employment because long-run aggregate supply has shifted from LRAS1 to LRAS2. Short-run equilibrium is at point B, with real GDP of $17.3 trillion and a price level of 112. By lowering interest rates, the Fed increases investment, consumption, and net exports sufficiently to shift aggregate demand to AD2 with policy. Equilibrium will be at point C with real GDP of $17.4 trillion, which is its full employment level, and a price level of 113. The price level is higher than it would have been if the Fed had not acted to increase spending in the economy. In 2005, equilibrium is at point A, with real GDP equal to potential GDP of $14.2 trillion and a price level of 92. From 2005 to 2006, potential GDP increased from $14.2 trillion to $14.5 trillion, as long-run aggregate supply increased from LRAS 2005 to LRAS 2006. The Fed raised interest rates because it believed the housing boom was causing aggregate demand to increase too rapidly. Without the increase in interest rates, aggregate demand would have shifted from AD 2005 to AD 2006 without policy, and the new short-run equilibrium would have occurred at point B. Real GDP would have been at $14.8 trillion, $300 billion greater than potential GDP, and the price level would have been 96.1. The increase in interest rates resulted in aggregate demand increasing only to AD 2006 with policy. Equilibrium occurred at point C with real GDP of $14.6 trillion, being only $100 billion greater than potential GDP, and the price level rising only to 94.8.
Okay.
Some economists have argued that rather than using an interest rate as its monetary policy target, the Fed should use the money supply. These economists belong to a school of thought known as monetarism. Followers of monetarism follow replacing monetary policy with a monetary growth rule. A monetary growth rule is a plan for increasing the money supply at a constant rate that does not change in response to economic conditions. By keeping the money supply growing at a constant rate, the monetarists claim the Fed would greatly increase economic stability.
In 1973, Japanese housewives going to market were faced with an unpleasant fact. The cash in their purses seemed to be losing its value. Prices were starting to soar as the awful story of inflation began to unfold once again. The Japanese government knew what to do. What's more, they were prepared to do it. When it was all over, economists were able to record precisely what had happened. In 1971, the quantity of money started to grow more rapidly. As always happens, inflation wasn't affected for a time. But by late 1972, it started to respond. In early 73, the government reacted. It started to cut monetary growth, but inflation continued to soar for a time. The delayed reaction made 1973 a very tough year of recession. Inflation tumbled only when the government demonstrated its determination to keep monetary growth in check. It took 5 years to squeeze inflation out of the system. Japan had attained relative stability. Unfortunately, there's no way to avoid the difficult road the Japanese had to follow before they could have both low inflation and a healthy economy. First, they had to live through a recession until slow monetary growth had its delayed effect on inflation. Inflation is just like alcoholism. In both cases, when you start drinking or when you start printing too much money, the good effects come first. The bad effects only come later. That's why, in both cases, there's a strong temptation to overdo it, to drink too much and to print too much money. When it comes to the cure, it's the other way around. When you stop drinking or when you stop printing money, the bad effects come first and the good effects only come later. That's why it's so hard to persist with the cure.
The Fed is forced to choose between using either the interest rate or the money supply as its monetary policy target. In this figure, the Fed can set a target of $900 billion for the money supply or a target of 5% for the interest rate. But the Fed can't hit both targets because it can achieve only combinations of the interest rate and the money supply that represent equilibrium in the money market. The Taylor rule is a rule developed by John Taylor that links the Fed's target for the federal funds rate to economic variables. According to the Taylor rule, the Fed should set the target for the federal funds rate so that it is equal to the sum of the inflation rate, the equilibrium real federal funds rate, and two additional terms. First, the difference between the current inflation and the target rate, called the inflation gap, and second, the percentage difference between the real GDP and the potential real GDP, the output gap. The inflation gap and the output gap are each given weights that reflect their influence on the federal funds target rate, with weights of 1/2 for both gaps. We have the following Taylor rule. Federal funds target rate is equal to the current inflation rate plus equilibrium real federal funds rate plus the quantity of half the inflation gap plus half the output gap. During the mid-2000s, the actual federal funds rate was lower than the predicted federal funds rate. Some economists, including Taylor, argue that these low targets for the federal funds rate contributed to an excessive increase in spending on housing. Inflation targeting is a framework for conducting monetary policy that involves the central bank announcing its target level of inflation. After many years of not having an inflation target, the Fed announced in 2012 that it would attempt to maintain an average inflation rate of 2% per year. With inflation targeting, the Fed can still respond to periods of economic problems without following an inflexible rule. But an inflation target allows monetary policy to focus on inflation and inflation forecasts except during severe recessions. Those who support inflation targeting argue that announcing a target draws public attention to what the Fed can achieve in practice and provides an anchor for inflation expectations. Proponents argue that inflation targets promote accountability for the Fed. Opponents of targeting are concerned that numerical targets diminish the Fed's flexibility to address other goals. Because monetary policy affects inflation with a lag, targeting requires the Fed to use forecasts of inflation that may not be accurate. Critics also claim that holding the Fed accountable for a goal of low inflation can make it more difficult for elected officials to monitor the Fed's support for good overall economic policy. Finally, inflation targets may increase uncertainty over whether the Fed will take prompt action to return the economy to full employment following a recession. Proponents of inflation targeting argue that a volatile inflation rate has negative effects for an economy. High levels of inflation eat away at savings, increase menu costs, discourage lending, and may create an inflationary spiral that leads to hyperinflation. Inflation targeting has been successful in keeping inflation levels low and avoiding many of these negative effects. Further, inflation targeting is a transparent way to explain interest rate policy to anchor consumers' expectations about future inflation. When the central bank announces an inflation target of 2%, the public knows that if inflation goes too far above or below that level, the central bank will take action. This certainty stimulates economic activity. Further, the public's expectations about inflation tend to be a self-fulfilling prophecy. When consumers expect high inflation, they spend their money immediately, attempting to avoid higher future prices. This increase in demand leads to higher prices, causing more inflation. Likewise, when consumers expect deflation, they tend to save their money, delaying consumption until prices fall. This decrease in demand causes producers to sell their goods at lower prices, and the cycle continues. Inflation targeting sets consumers' expectations, making a certain inflation level easier to maintain. On the other hand, some argue that the costs of inflation targeting exceed the benefits. If the rule is implemented very strictly, an inflation target could severely limit the central bank's flexibility in responding to changing economic conditions. During a recession, for example, central banks should not raise the interest rate even if inflation is above the target level. Further, sometimes higher inflation is a good thing because it stimulates spending. A central bank with a strict inflation targeting rule, however, would not allow that higher inflation rate even if it were otherwise beneficial. Still, others argue that since inflation is not necessarily coupled to any factor internal to a country's economy, inflation is not the best variable to target. Adherents of market monetarism, for example, argue that targeting a nominal national income, nominal GDP, would be more effective than targeting inflation. Others suggest targeting long-run inflation, which takes the exchange rate into account, rather than the short-term inflation rate. Federal Reserve policymakers evaluate changes in inflation by monitoring several different price indices. A price index measures changes in the price of a group of goods and services. The Fed considers several price indices because different indexes track different products and services, and because indices are calculated differently. Therefore, various indices can send diverse signals about inflation. The Fed closely tracks several inflation measures, including consumer price indices and producer price indices, issued by the Department of Labor. The Producer Price Index reveals details important to U.S. businesses, but it does not directly relate to consumer costs, and it is rather volatile in comparison to other measures. That volatility may be favorable for a business to understand what is happening in the economy, but on the national macroeconomic level, it may show too much resolution. The Fed often emphasizes the price inflation measure for personal consumption expenditures, PCE, produced by the Department of Commerce, largely because the PCE index covers a wide range of household spending. Policymakers examine a variety of core inflation measures to help identify inflation trends. The most common type of core inflation measures excludes items that tend to go up and down in price dramatically or very often, like food and energy. For those items, a large price change in one period does not necessarily tend to be followed by another large change in the same direction in the following period. Although food and energy make up an important part of the budget for most households, and policymakers ultimately seek to stabilize overall consumer prices, core inflation measures that leave out items with volatile prices can be useful in assessing inflation trends. Core PCE is one of these indices routinely used since about 2004 as an inflation indicator. The largest detractor of this index is updates, happening only annually, not monthly or even quarterly.
We're back right now with former Federal Reserve Chairman Dr. Ben Bernanke talking with us today about monetary policy and fiscal policy. Dr. Bernanke, what's your take on fiscal policy? What would you like to see, and what do you think about the president's proposal so far? He's talking about a 15% corporate tax rate. I doubt that's going to happen because we know that the House has a much higher corporate tax rate. He's talking about a 15% business tax rate, and of course, much lower taxes for most Americans. What's your take on that?
Well, we're at a point in the business cycle where we're pretty close to full employment, so we don't need extra spending. We don't need to give higher income to consumers to stimulate spending for that side of the economy. What we need is fiscal reforms that are increase the supply side of the economy, allow us to grow faster in a sustainable way. And I think probably of the various fiscal proposals, the two that have the most potential for supply side growth, one would be tax reform on the corporate side, make that more efficient, try to promote more capital investment. And the second would be smart infrastructure investment to make us more productive. And we all lose a lot of time on busy roads and inadequate bridges, and good infrastructure can make us more productive over the long term.
Do you worry about the debt with all of that? I mean, we're talking about an infrastructure plan that could cost $1 trillion. Obviously, cutting taxes is also going to cost in the trillions. What about the debt and the deficits? What's your take on the $20 trillion in debt and the impact of all of that?
Well, that's the reason why I don't think we can do all this. I think we have to prioritize. And I think, again, the higher priority would be to reform the corporate tax code, make it more efficient. That could be done with moderate increase in deficit. Infrastructure spending, if it's good, can at least partially pay for itself in that if you do good maintenance today, you don't have to do that maintenance tomorrow. If you make the economy more productive, that increases your tax revenues to some extent. So, again, I think that if you prioritize, you can have the most effect on the economy without blowing up the deficit too much.
In terms of tax reform, do you think that that will dictate corporate behavior? In other words, if you see a repatriation tax all the way down to 8 or 10%, which is what the president is talking about, he says there's $5 trillion overseas. Now, we've been talking about $2.5, $3 trillion. He says it's $5 trillion. And he said that if he can put in a repatriation tax of 8 or 10 or 12%, companies will bring that money home. Do you agree with that?
Well, they'll bring some of it home, and we've seen this before. We had a similar situation under the Bush administration. So there will be a one-time windfall of some hundreds of billions of dollars, which is good because it'll help maybe smooth the way for example, for corporate tax reform. But it's a one-time thing. It's not a permanent source of revenue, so you don't want to overstate that. But there is a one-time benefit there that can be gotten by the repatriation.
The Fed lowered the target for the federal funds rate during the 2001 recession to stimulate the demand for housing. The policy was successful, but by 2005, many economists argued that the bubble had formed in the housing market. The price of a house should reflect the value of the services the house provides. By 2005, some economists believed that in some cities, prices had inflated so much that monthly mortgage payments were far above the rent on comparable homes, a situation of mortgages being out of sync with rents, or simply put, out of whack with comparable costs in the economy. During 2006 and 2007, prices of new and existing homes in most markets were declining. When lenders foreclosed on some mortgage loans, those lenders then sold the homes, causing prices to fall further. Subprime loans are loans granted to borrowers with flawed credit histories. Mortgage lenders that had concentrated on making subprime loans suffered heavy losses. Most other banks and other lenders tightened the requirements for borrowers. This credit crunch made it more difficult for potential homeowners to obtain mortgages. Typically, housing prices increase at about the same rate as housing rents. But during the housing bubble, housing prices increased far more than did rents. Sales of new homes in the United States went on a roller coaster ride, rising by 60% between January 2000 and July 2005, before falling by 80% between July 2005 and May 2010. Until the 1970s, the commercial banks and savings and loans that granted mortgages kept the loans until the borrowers paid them off. Many members of Congress believed that home ownership could be increased by creating a secondary market in mortgages. If a bank or savings and loan granted a mortgage and then resold it to an investor, the bank could use the funds to grant another mortgage. In this way, banks and savings and loans could grant more mortgages because they would no longer depend only on deposited funds for the funds needed to make loans. Most investors were unwilling to buy mortgages because they were afraid of losing money if borrowers defaulted on their loans. To reassure investors, Congress used two government-sponsored enterprises, GSEs, the Federal National Mortgage Association, Fannie Mae, and the Federal Home Loan Mortgage Corporation, Freddie Mac. By the 1990s, a large secondary market existed in mortgages, with funds flowing from investors through Fannie Mae and Freddie Mac to banks, and ultimately individuals and families borrowing money to buy houses. By the 2000s, further changes had taken place in the mortgage market. First, investment banks became significant participants in the secondary market for mortgages. Investment banks bought mortgages, bundled large numbers of them together as bonds known as mortgage-backed securities, and resold them to investors. Mortgage-backed securities became popular with investors because they paid higher interest rates than other securities with comparable default risk. Second, lenders had loosened the standards for obtaining a mortgage loan. By 2005, many mortgages were being issued to subprime borrowers with flawed credit histories. Lenders created new types of adjustable-rate mortgages that allowed borrowers to pay very low interest rate for the first few years of the mortgage and higher rates in later years. Both borrowers and lenders anticipated that housing prices would continue to rise. But the decline in housing prices led to rising defaults, and the value of mortgage-backed securities declined sharply. Many commercial and investment banks owned mortgage-backed securities, so the decline in value of these securities caused these banks to suffer heavy losses. By mid-2007, the decline in the value of mortgage-backed securities and the large losses suffered by commercial and investment banks caused turmoil in the financial system. A leveraged loan is a loan extended to companies or individuals that already have considerable amount of debt. Lenders consider leveraged loans to carry a higher risk of default, and as a result, a leveraged loan is more costly to the borrower. Consider a real estate investor who has $50,000 in cash. That investor could use that money to buy one home valued at $50,000. If that home could quickly be sold for $55,000, the investor would have gained $5,000. If that same investor used the original $50,000 in cash to put a $5,000 down payment on 10 different homes valued at $50,000 each, financed the rest of the money, and then sold all 10 homes for $55,000 each, the investor's profit would have been $50,000. An astounding 100% return on investment. Suppose the investor would use 10 down payments of $5,000 each to purchase 10 homes valued at $50,000 each. If real estate prices fall and those homes are now only worth $45,000 each, the investor would take a $50,000 loss, 100% of the initial amount invested, if the homes even sold. If the value of the homes fell to $40,000 each, the buyer's potential loss of $100,000 is 200% of the original investment amount. In each scenario, the buyer would also need to continue making mortgage payments, including interest and insurance payments, in addition to periodic home maintenance. In these scenarios, the losses can add up quickly, and the amount lost can become substantial. Thus, we see the risk of leveraged loans.
It's been 8 years since the beginning of the financial crisis when the Federal Reserve enacted unprecedented policy measures. These were both widely praised and staunchly criticized. Joining us now is former Fed Chairman Ben Bernanke, author of the new book, The Courage to Act, a memoir of a crisis and its aftermath. Welcome, Dr. Bernanke.
Nice to be here.
Do you miss being chairman of the Federal Reserve?
I do not. I love being a civilian. I'm happy when I open up the newspaper and I see a problem and I say, well, I hope somebody can do something about that. It's not going to be me.
So do you care about your legacy? I mean, you spent a lot of time writing this book. Is this something you're looking to?
Well, you know, of course I do care about my legacy, and I think most people would. But I'm also, you know, I think it's also important for us as a country to understand what happened. If people have the wrong understanding of what happened, they think it was purely a Wall Street bailout without any consequences for the broader American economy, they're going to make the wrong decision in the future when they come to some kind of crisis. So I think it's really important for us to understand what happened. And I do, you know, I shouldn't admit this, but I actually put some economics in the book because I want people to understand what we were thinking and what the basic causes of the crisis were. So I felt it was important to lay that out, both for the future, so people, historians and others, can understand what happened. And also because the Fed, I think, needs to tell its story to offset some of the negative press that it's gotten.
You talk about economics. I know you're very data-driven, obviously, but how much does your gut come into play when you're making decisions, particularly in those dark moments?
Well, I try as much as possible to be as systematic, laying out the facts, laying out the analysis, hearing the staff's views, hearing other policymakers' views. You know, there's a tendency to make errors when you make spontaneous decisions, and it's important to be as systematic as possible. So I tried to do that. But in the end, sometimes it came down to, as you say, you know, based on all your experience, based on your instinct, based on what you know, what's the right thing to do. And sometimes that was the deciding factor. But
what would be an example of when you did that?
Well, I knew, for example, in this AIG rescue that it was going to be terrible for the Fed. It was going to be politically very, very problematic. The Congress basically told me that they were not going to support this in any way and that the Fed was going to take all the responsibility. But I also knew, based on many years of study as a professor and my experience as a Fed chairman in the driver's seat there, so to speak, I was quite certain that the effects of letting the world's largest insurance company just collapse would be extraordinarily serious. And I didn't feel that that was a chance that we ought to take, that the country ought to take. And so in the end, I could have talked myself out of it, but I didn't. I felt that making that decision was the right one. I still think it was the right one. And, you know, it came from both my rational thinking, but also my experience and my gut, as you put it.